Hey guys, Mr. T again in another video. This one's on savings accounts. This will help you with exercise 3D.1 of your book. So, like I said earlier in the term, this is more real maths. This is how it works in the banks. So hopefully it's going to be useful for you, and because it's relevant, you might enjoy it a bit more. A lot less exercises as well as we go through, so you'll notice that too. So savings accounts are bank accounts. Hopefully you've got one. That you deposit your money into so it can grow from interest. I didn't have that before until I started teaching this maths, and I didn't realise that you could earn interest from the bank. Silly of me, but that's what happens when you do the HEL 5 set of subjects. So in savings accounts, the interest is calculated every day, each and every day, based on the account balance, so whatever is in the account. The account balance is whatever is in your account at that point in time. And then the interest is paid into the account at the end of each month. So it's not like compounding interest the whole time, because your balance can change. Okay, we have to treat this slightly differently. It's compounding sort of every month, but because it can change in the middle, it's a bit more complicated than that. So what you're going to see is we need to do multiple calculations for these. In this situation, for savings accounts, you need to calculate the interest earned for each month. So if your question is across a couple of months, you need to put the interest in at the end of the first month and then do the calculations again for the second part, the next month. Also, the interest earned for each set of days with the same balance. So if the balance changes, even if it's in the same month, you also have to do an interest calculation for that too. You're calculating these all separately and then adding them up at the ends, and you're using the simple interest formula. So just to make that clear, because that is quite confusing if you just read the words, we're going to do an example. This is from the book. Justin has a savings account paying 3.1% per annum. Find the interest he earns in May using this transaction information below. So this table here, you'll see tables like this in your book for these kind of questions. So on the 1st of May, he hasn't made a transaction. It's just telling you that's what he started with. He started off with $430.25. On the 10th of May, he deposited $2,380. So on the 10th of May, he suddenly had $2,810.25. So basically what that's telling you, so reading into it, from 1 of May to 9 of May, he's got $430.25. From 10th of May onwards, he's got $2,810.25. And then on the 25th of May, he withdrew $800. So that brought his balance down to $2010.25. So reading into that again, from the 10th to the 24th of May, he had $2,810, and then on 25th to the end of May. So hopefully you know the trick with your hand. If you clench your fist and put it out in front of you, your knuckles are the 31-day months, and between the knuckles are the 30-day months. So January is a knuckle, February, March, April, May. So May is a 31-day month. So May is going to be, he's going to have from the 25th to the 31st at $2,010.25. So what you can see here is you've got 1 month, but 3 different balances. So you're going to need to do 3 different balances, so 3 separate interest calculations, and you'll see them below. Okay, so it's using the simple interest formula. So back to a nice easy one. You're not using a calculator for this. Unfortunately, there's no app that lets you do this these multiple steps straight away. So from 1 May to 9th of May. You need to work out how many days that is. So 1, 2, 3, 4, 5, 6, 7, 8, 9. That's 9 days, and that is inclusive. 9th of May balance was $430.25. So you need to work out the interest that Justin earns on these 9 days for that balance. Okay, so SI is equal to PRT. So principal is the balance for $30.25 times by the rate. It's 3.1%, so we need to convert that to a decimal, 0.031 times by the time. So here is the difficulty, because time is usually in years. You need to work out what fraction of a year it is. So it was 9 days. 9 over how many days in a year? 365. So if you work that out, work out what 9 divided by 365 is first, times by 0.031, times by 430.25. That comes to approximately 0.33 to 2 decimal places. So that's in dollars, so therefore 33 cents for first 9 days. So we've only done the first part. I'm going to do the second bit. 10 of May to the 24th of May, which is how many days? 10 is, and it's inclusive. 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. That's 15 days. The balance was, because it grew, he put money in, $10.25. Notice how we haven't added this 33 cents to it, because remember the interest is only added into the account at the end of the month. We just need to know how much interest was generated from this balance of $430.25. Add it all up at the end. So SI is equal to PRT again, but this time it's going to be $10.25 times by the rate of 0.031 times by the fraction for how many days it is. So 15 over 365, that comes to 15 divided by 365 times by 0.031 times by 2810.25. That comes to 3.58 to 2 dp. Therefore, $3.58 for next 15 days. So we're up to the last section, the last part of this month, which is the 25th of May to 31st May. And we need to work out how many days that is, inclusive, 25, 26, 27, 28, 29, 30, 31, that's 7 days. Balance was, because he withdrew $800, down to $10.25. So same formula again. $10.25 times by the rate, 0.031, times by the fraction of days, 365. So work that out, 7 divided by 365 times by 0.031 times by 2010.25. That approximately 1.2 to 2 decimal places. Therefore, $1.20 for last 7 days. So we've done all 3 sections. Now you just need to do what I set up here, which is to add up the interest for the month. So we know how much interest Justin earns for the month of May. Therefore, interest earned for May is going to be 33 cents plus $3.58 plus $1.20 . That comes to $5.11 interest. Okay, so that's pretty much how it works. You just need to be careful if you've got a crossover of months. So if it went from May into June, you would need to add the interest earned for May into the balance. Okay, there might be a couple of examples of that in your questions, but as long as you separate it into the sections where it's the same balance, so see how the balance was 430 for those days, 430 calculation, the balance was 2810 for that, so there's a separate calculation for this, and there was another balance of 2010, so a separate calculation for this, add them all up at the end to get the total interest they earned for the month. So hopefully that helps you out, and I will see you on the next video.